You book a hotel in Las Vegas because the room looks cheap. Maybe $99 a night. Maybe even less. At first, it feels like you found a deal. Then you arrive, and the real bill starts showing up. A resort fee you never expected. A parking fee if you brought a car. A charge for early check-in because your flight landed too soon. That bottle of water sitting in your room? Not complimentary. Sometimes even your restaurant bill arrives with extra service charges buried in fine print. Suddenly, that cheap Las Vegas vacation doesn't feel cheap anymore. And travelers are noticing. Online reviews keep repeating the same complaint. People aren't just frustrated about paying more. They're angry because many of these charges feel hidden until it's too late. And that anger is becoming a real business problem. Las Vegas was built on a very simple promise. Come here, spend freely, and feel like you're escaping reality for a few days. But what happens when visitors start feeling charged at every step? And more importantly, are these hidden fees helping casinos survive financial pressure, or quietly pushing tourists away from Las Vegas altogether? For decades, Las Vegas understood a very simple rule. Get people into the building first, worry about making money later. That was the old formula. Hotel rooms were often sold at aggressively low prices because the room itself was never the real business. The real money came after guests arrived. They gambled on casino floors, bought expensive cocktails, attended shows, shopped inside luxury retail spaces, and ate at celebrity restaurants. A cheap room was really a marketing tool. Its job was to pull people into a much larger spending machine. And for years, that model worked extremely well, especially for major operators like MGM Resorts International, Caesars Entertainment, and Wynn Resorts. Before the pandemic, Las Vegas welcomed more than 40 million visitors every year. Hotel occupancy across the Strip remained strong, and casinos became increasingly aggressive about maximizing revenue from every visitor. But there was a growing problem in the background. Traditional gambling revenue was becoming less dominant. Regional casinos expanded across the United States. Online sports betting pulled younger customers away. International tourism became less predictable, and inflation made travel harder for middle-class families. Casino operators had to rethink how they monetized each guest. That's when fees became a major strategic tool. Resort fees were originally introduced as a way to separate advertised room prices from mandatory property charges. Operators said those fees covered things like Wi-Fi, gym access, pool access, and business services. But once travelers accepted resort fees, the list kept growing. Paid parking expanded across major Strip resorts. Early check-in fees became common. Late checkout fees increased. Minibar charges became more aggressive. Restaurants,
automatic service fees. Even basic convenience items inside hotel rooms became profit opportunities. From a corporate perspective, it looked smart. Advertise lower room prices. Appear competitive online. Recover revenue later through mandatory add-ons. But this strategy created a dangerous psychological shift. Guests no longer felt like they were spending voluntarily. They felt trapped inside a system designed to charge them at every possible moment. And once that feeling spreads, getting them to come back becomes much harder. To understand why these fees keep multiplying, you have to look at where casino profits are actually coming from now. And the answer is very different from what many tourists imagine. People still picture Las Vegas as a city built almost entirely on gambling losses. Slot machines, black tables, poker rooms. That image still exists, but financially, the business model has changed. For major Strip operators like MGM Resorts International and Caesars Entertainment, non-gaming revenue now makes up a massive share of total earnings. Hotel rooms, food and beverage, nightclubs, entertainment, convention traffic, and increasingly, fees. At MGM properties, hotel operations generate billions of dollars every year. and room revenue is highly profitable. Once the hotel is built, adding another guest costs relatively little compared to what that guest pays. But Wall Street wanted even more predictable margins. Gaming revenue fluctuates. High rollers can win. Economic downturns reduce gambling budgets. Tourism demand rises and falls. Fees are different. They're stable. A mandatory resort fee gets charged whether someone gambles or not. Parking fees generate income whether visitors win or lose. Late checkout fees require almost no investment. Minibar markups can be extreme. From an executive perspective, that creates very attractive margins. Imagine a property hosting millions of guests every year. Adding $20, $30, or $40 in mandatory fees per stay can quietly generate tens of millions in additional revenue. That's why these charges spread so aggressively, and investors often reward it. Public casino companies are constantly under pressure to improve EBITDA, earnings before interest, taxes, depreciation, and amortization. It sounds technical, but the idea is simple. Investors want proof that a company can extract more profit from what it already owns. Higher revenue per room, higher guest spending, higher operating margins. That often helps the stock. But there's another side to that story. Hotel demand has become less predictable. During conventions, sporting events, and holidays, room prices surge. During slower periods, operators slash rates to keep occupancy high. That volatility creates pressure to recover revenue elsewhere. And debt matters too. Many casino operators carry billions in debt tied to acquisitions, property upgrades, and shareholder expectations. Caesars years managing heavy debt after major mergers. MGM continues balancing large capital investments. Las Vegas Sands shifted strategy after selling major strip assets. These companies operate enormous physical properties with massive fixed costs. Hotels need staff. Casinos need security. Restaurants need labor. Buildings need constant maintenance. Energy costs remain enormous. When expenses rise faster than visitor spending, executives start looking for easy revenue. And hidden fees are often the fastest answer. No new resort, no major renovation, no need to attract new gamblers, just charge existing visitors more. The short-term math looks great, until guests begin changing their behavior. They shorten trips, they spend less on entertainment, they avoid certain resorts, and sometimes they stop visiting Vegas entirely. That's when a revenue strategy becomes a long-term demand problem. And the timing made it even worse. Las Vegas wasn't raising fees during a tourism boom with unlimited demand. It was doing it at a time when travelers were becoming far more price-sensitive. After the post-pandemic recovery surge, many casino executives believed travel demand would remain unstoppable. For a while, it looked true. Hotel rates climbed aggressively. Major conventions returned. Premium events like Formula One helped push prices even higher. Then, reality arrived. Airfare became more expensive. Food prices increased. Credit card debt rose across American households. Consumers became far more selective about discretionary spending. A weekend in Las Vegas suddenly required a much larger budget than many travelers expected. And social media accelerated the frustration. Travel creators started posting hotel bill breakdowns. Visitors uploaded videos exposing hidden charges. Reddit communities filled with complaints about resort fees, paid parking, overpriced drinks, and surprise restaurant charges. The old Las Vegas model depended heavily on emotional spending. People needed to feel excited enough to spend impulsively. But when travelers start calculating every expense before they arrive, that emotional spending starts to weaken. And Las Vegas faces another structural problem. Competition is no longer limited to nearby casino markets. Atlantic City still competes for East Coast gamblers. Macau dominates high-end Asian gaming. Regional casinos across states like Florida, Pennsylvania, and California now keep customers closer to home. And sports betting apps changed behavior even further. People can now gamble from their couch. No airfare, no hotel costs, no parking fees, no overpriced cocktails. That doesn't fully replace Las Vegas, but it reduces urgency. Then came another image problem. During events like Formula One, many tourists complained that regular visitors were treated like secondary customers, while the city prioritized ultra-wealthy guests. Expensive ticket packages, road disruptions, massive hotel price spikes. To many
middle-income travelers, the message felt clear. Las Vegas still wants visitors, just wealthier ones. And that may be the biggest risk of all, because Las Vegas was built on mass tourism. And if enough ordinary visitors begin feeling pushed out, the long-term economics become much more fragile. This is where the issue becomes much bigger than annoying hotel fees. The deeper problem may be that Las Vegas slowly misunderstood what made it successful in the first place. For decades, Vegas mastered a powerful emotional formula. Visitors felt like they were getting away with something. Cheap flights, affordable rooms, free parking, free drinks while gambling, buffet deals, discounted shows. Even when people lost money in casinos, many still left feeling entertained. That feeling mattered, because people returned not only for gambling, but because Vegas felt like value wrapped in excitement. That formula changed. Today, many visitors feel like every part of the trip has become transactional. Want to park? Pay. Want faster check-in? Pay. Want a better room view? Pay. Want bottled water late at night? Pay an absurd markup. Want dinner? Watch for hidden service fees. That creates something analysts often call price fatigue. Not because people can't spend money, but because they start questioning whether the experience feels worth the cost. And that question is dangerous in entertainment businesses. Disney can justify premium pricing because families see the experience as emotionally irreplaceable. Luxury resorts like Wynn can justify premium pricing because they intentionally target wealthy guests. But mid-market Vegas properties face a harder challenge. They often charge premium-level fees while still targeting middle-income travelers. That creates a mismatch. People paying luxury prices expect luxury treatment. Instead, many feel trapped in a maze of monetization tactics. And casinos may have become too dependent on extracting more value from fewer visitors. That works in the short term. Higher spending per guest can make quarterly earnings look strong. But if customer satisfaction declines over time, demand erosion can quietly begin underneath those financial reports. There's also a strategic complacency problem. For years, executives believed Las Vegas was unique enough that tourists would keep coming no matter what. But younger travelers now have alternatives: international travel, cruises, sports tourism, theme parks, short-term rentals, digital entertainment. Vegas is no longer competing only with casinos. It's competing with nearly every leisure experience fighting for disposable income. And when travelers start saying, "I had fun, but I felt ripped off," that sentence becomes very expensive over time. Because the biggest threat isn't one angry tourist. It's millions of people deciding their next vacation should happen somewhere else. And when customers start pushing back, the pressure doesn't stay outside. It starts showing up inside the business. Casino operators rarely announce panic. They communicate stress in quieter ways. Hiring freezes, reduced staffing, shorter restaurant hours, delayed renovations, tighter housekeeping schedules, more automated check-in systems.
Visitors may not notice each change individually, but together, they signal a company trying to protect margins. Some Las Vegas properties have reduced daily room cleaning unless guests request it. Others rely more heavily on digital check-in systems to reduce labor costs. Restaurants inside resorts have shortened operating hours during slower periods. From a financial perspective, these decisions can make sense. Labor is expensive. Utilities are expensive. Operating massive resorts 24 hours a day creates enormous overhead. Executives are under constant pressure to prove efficiency. But aggressive cost-cutting can quietly damage the guest experience. Longer wait times, lower service quality, less flexibility, fewer visible staff members, and customers notice when premium prices come with weaker service.
That combination often creates even more resentment than pricing alone. Leadership changes can also signal stress. When boards become unhappy with long-term growth, executive turnover often increases. New leadership teams promise operational discipline, cost optimization, and restructuring. Those phrases sound polished on earnings calls, but they often mean one thing. The company is trying to stabilize profitability. Casino floors can reveal stress too, not necessarily through crowd size, but through spending behavior. Guests may gamble less, spend less in restaurants, avoid premium retail stores, and shorten their stays. That creates a difficult cycle. Higher fees frustrate customers. Frustrated customers spend less. Lower spending pressures margins. Companies respond with even more fees or deeper cost cuts. And that cycle becomes difficult to break, because once customers begin expecting disappointment, winning them back becomes far more expensive than keeping them happy in the first place. Casino operators are not ignoring the backlash. They know people are complaining. The real question is whether their solutions actually solve the problem. One response has been aggressive discounting. You'll often see extremely low room prices during slower weekdays. $39, $59, sometimes even lower. The strategy is obvious. Get people to click. Get them emotionally committed. Then recover profits through resort fees, dining, entertainment, and on-property spending. That tactic still works in the short term. But repeat visitors are getting smarter. They now calculate total trip costs instead of reacting to advertised room prices. Another strategy has been targeting higher-income travelers. Luxury expansions, premium nightlife, exclusive gaming salons, VIP events, all continue growing at major resorts. Events like Formula One and the Super Bowl were also seen as opportunities to attract high-spending visitors. And for certain weekends, that strategy works very well. But those events don't solve year-round demand problems. Las Vegas still needs millions of regular tourists filling hotel rooms during ordinary weeks. Some operators expanded loyalty programs, free play offers, discounted room packages, dining credits, return incentives. These programs are designed to keep repeat visitors inside company ecosystems. Others invested heavily in sports entertainment, concerts, and convention business to reduce dependence on gambling revenue. That strategy makes sense. But there's a deeper issue. Most of these solutions focus on generating new spending. Very few address the trust problem. And trust matters. If visitors believe pricing isn't transparent, discounts can feel manipulative, not generous. If guests expect surprise charges, even luxury upgrades become less appealing. The deeper problem may be psychological. Las Vegas spent decades building excitement. Now it may need to rebuild credibility. And that's far harder than launching another promotion. Las Vegas probably isn't collapsing tomorrow. The casinos are still operating. Resorts are still full during major events. Billions of dollars still move through the Strip every year. But long-term business problems rarely begin with empty buildings. They begin when customer trust starts weakening. That's why these hidden fees matter. A resort fee alone won't destroy Las Vegas. Neither will parking charges or overpriced bottled water. But together, they create something far more dangerous. A growing feeling that visitors are being monetized at every possible moment. And once that feeling becomes part of Las Vegas's reputation, it spreads far beyond a single vacation. People warn their friends. Travel creators post breakdown videos. Families choose other destinations. Convention planners rethink budgets. That kind of reputation damage happens slowly, then suddenly. Las Vegas built its empire by making people feel like they were stepping into a world of excitement, escape, and possibility. But if that experience starts feeling like a series of hidden invoices, how long can this model really last? And if casinos keep charging guests for things they never asked for, what happens when those guests stop showing up? Subscribe for more breakdowns like this.